Everyone is waiting for the Bank of Canada to announce more rate cuts, but behind the scenes, Canadian banks are quietly doing the exact opposite. They're actively making mortgages more expensive, and they're doing it right now. So if you're buying a home or you're renewing a mortgage this spring, you need to watch this because you could potentially be walking into a trap. In the next few minutes, we're going to cover the fixed rate bond panic, the tricks that lenders are playing on variable rate discounts, and finally, a step-by-step action plan to lock you and your money in before rates start climbing any higher. Most Canadians think mortgage rates only change when the Bank of Canada makes an announcement. And to be honest, that's completely false. Fixed-rate mortgages are actually tied to the Government of Canada bond yields, and right now, the bond market is panicking. Between March 3rd and March 9th, the 5-year bond yield suddenly spiked from 2.79 up to 2.91%. Why? Because of global inflation fears and the rising prices of oil linked to the conflict with the US and Iran. Investors are spooked, and when bond yields go up, your fixed mortgage rates go up with it. But what does this actually mean for you? It means the cheap fixed rate that you looked at about 3 weeks ago, well, it could already be gone. On a $500,000 mortgage, a sudden rate jump means you are losing hundreds, if not thousands of dollars per year in pure interest, stolen straight from your pocket, all while the Bank of Canada is technically doing nothing. Now, you might be thinking, okay, Myles, I'll just take a variable rate then. Well, not so fast. Lenders are squeezing on those as well, and they're passing the bill on to you. Right now, the prime rate is sitting around 4.45%. Usually banks offer a discount on that, let's say prime -1. But because lenders are trying to protect their profit margins and there's some volatility, they are quietly shrinking the discount you actually receive from the prime rate. So let's say it started off at prime -1, they could potentially move that down to prime -0.9 or prime -0.85. So what's the wallet impact here? Even though the Bank of Canada hasn't touched the official rate, that variable rate mortgage just got 0.15% more expensive behind your back. You're paying more simply because the bank changed the math on the discount that they provide on prime. So how do you beat the bank at this game of push and pull? Well, you need to trigger a 120-day or 90-day rate hold, whatever the lender is offering, and you need to do it as soon as possible. Now, you're going to want to keep in mind that with lenders that offer these rate holds, they commonly don't offer it on their entire book of products. And there are lenders out there who actually upcharge on the interest rate if you want a rate hold. In fact, there are lenders that won't even do rate holds at all. So making sure you're working with lenders that offer these or working with a broker that can access around 60 different lenders can be truly beneficial in these environments where rates are volatile and potentially increasing. I want you to think of a rate hold as almost a free insurance policy. If bond yields keep spiking and fixed rates go up, you get to keep today's lower rate. If rates magically drop, you get the new lower rate anyways. There's pretty much zero downside to this. If your renewal is coming up in the next 6 to 4 months, don't wait for the bank to send you a letter in the mail. They are hoping that you're sleeping at the wheel so that they can charge these new higher interest rates. Now that you know these fixed rates are secretly creeping up, you need a broader game plan for the rest of the year. To see exactly where the Bank of Canada is heading next and how to structure your 2026 mortgage strategy to survive all this chaos, click this video right over here for my 2026 mortgage forecast. Thanks so much for tuning in. If you got value out of this, make sure to like and subscribe. We'll see you on the next video.